Welcome back, traders, to the Options Trader Lounge. And in today's video, we're going to be discussing the crazy wild moves that we are seeing in the market. And as you can see, we are down 3 weeks in a row on the triple Qs. However, on the account, we are up nearly 10 grand. That is right, 10 grand on this sell-off because we were prepared weeks ahead of this sell-off because we knew that something big was going to happen, right? Unlike, as you can see, what I'm drinking, Trader Joe coffee, they understand what is a fair trade. And in trading, it is the exact same way. No matter which way the market goes, up or down, it is still a fair trade. It seems unfair if you're on the wrong side of the trade, and that is what we try to solve for in this channel. So if you want to learn more, please go ahead and subscribe to the channel. Please leave a like down below. And if you know anybody that would find this video useful, please go ahead and share this video. We'll greatly appreciate it. Now, without further ado, let's get right into it. Welcome to the Options Trader Lounge, where we talk about generating income and growing your wealth within the US stock market using options. Thank you all for tuning in. Get yourself a drink, sit back and relax. Now let's get into it. Yeah, the triple Qs, the tech heavy sector, is now in a correction mode, right? Down 6% from top to bottom. This is typically a point where we would assume for some sort of pullback, some sort of bounce in the market. But at this moment in time, it does not look like it's shaping up to that because, closing at this level, we would have to wait for the next candle to form to actually see where the market wants to go. If we do see some sort of a hammer candle like this candle right here, we can assume that the market is hammering out a bottom for a possible rebound in the market. But that is not what we are seeing at this moment. I know this is a Thursday close. We need one more trading day, which is Friday, to actually form this actual candle to be a true weekly candle. So Friday is going to be an important pivotal moment for this week's trading session. Now, I know it's crazy. I understand that many of you who did not see this sell-off to come about, you may have caught off guard by this massive and rapid sell-off. We just seen a rapid sell-off back here in 2020, and who knows? We don't know if we are going to get a repeat of this sell-off at this moment in time for the second half of 2023. Now, what's the explanation of this sell-off? Well, the problem with making this point is that whoever you listen to, no matter who it is, if it's some sort of genius that's on YouTube or your financial planner who sits across their desk at a financial firm, they can appoint any reason for the way the market moves the way it does. But in all realities, nobody knows what the market is going to do. Nobody can attribute the exact precise reason why the market is moving, and hence the reason why, to be successful at trading, you have to remain neutral in the sense that nobody knows a clue about the direction of the market, right? All you have in terms of judgment making whenever you're trading is the ability to find the optimal point in a trend where you have high risk reward. Therefore, you could execute the trade in a probabilistic standpoint. Now, as we can see, this sell-off here is quite pronounced, and also it's quite rapid. What is going on here? For some reason, my cursor is not working. If anyone could figure this out, let's try this. Oh, looks like it does not want to work for me to zoom in. That is a shame. Anyways, well, the reason for this sell-off, right? In my opinion, my only guess is the destruction of demand that the Fed is trying to induce in the market. And what do I mean by that? As you can see in this article here by Market Watch, it is explaining that treasury yields keep rising. And as we know, the way the Fed wants to form this market is by keeping yields higher for longer. Now, what does that do to the market? Well, obviously, it's going to increase the rate of which borrowing is going to be able to be affordable, right? So as we can see, the 10-year Treasury note is yielding a 4%, which was the high back here in July. And as we can see here on the 30-year Treasury bond, that is yielding, again, near the highs at 4%. And the higher this stays and the longer it stays, um, it's ultimately going to cause the destruction of demand. And how can we see this destruction? Well, we can see it greatly in obviously the stock market. As we can see, the stock market is rapidly selling off at this moment in time. And also the biggest area of demand, which we all know we saw great demand, especially when everyone was trying to work from home, was in the housing market, right? Everyone wanted to own a home because nobody wanted to work in an office. And so realtors were real estate agents were selling houses, and people who were trying to buy a house was literally having to outbid other bidders just to own the house. And how crazy that was that, that moment in time. And we saw this huge ramp up in housing prices, right? As you can see here, uh, from 2020 all the way to 2022, right? When money was cheap and people were bidding out each other just to own property. And what do we see here when the Fed started to hike rates? We saw this sell-off in housing demand, and the median price of housing sold in the United States declined up here from 479 all the way down to 416. That's almost a $100,000 decline in housing prices, in median housing prices. So, you know, ultimately, nobody can afford an expensive house, especially if wages would not keep up, right? It just doesn't make sense. And so, this hence the reason why the Fed wants to keep interest rates high so that way things can normalize. In a market where prices just keep going up and up and up to the point where things become unaffordable, that's going to cause destruction in the market, and at the point where nobody could survive their payments for their mortgage, and let alone their normal expenses, right? And so the reason why we saw this big sell-off in the market. So looking at the market, we saw a consistent ramp up in price on the S&P 500, and eventually, once we saw this MACD indicator start to slow down and creep down, that was our signal to start hedging. And because we were able to hedge our positions, any losses that we were able to sustain was obviously neutralized by our hedge. And once we saw the trend change, that is when we went full on short in the market and was able to rack up the dollar amounts in the account to be able to, uh, remain consistently profitable in the market as we saw a decline as asset prices dropped. And so that is the whole strategy that we were able to implement and catch the move early ahead of the time, because as we know, the whole purpose of hedging is really just to preserve capital and reduce losses. And so hedging is always important to do in any strategy. And the most important thing that you got to do is figure out your risk, your management of capital. And so, if you follow along with the channel, you're able to see that happen, and you're able to capitalize on the trend change in the market. And at this moment in time, we are looking at this level here on the S&P 500, along with the triple Qs, that on the weekly candle that it is going to hug and possibly sustain this 15 weekly moving average. And if it does not sustain it, that is unfortunate. The next level down is going to be 430 on the S&P 500 as it correlates to this previous top here too. And we're looking to possibly see, former resistance turn to support, and also back here in June to form a possible support if it does fail this moving average. Looking at the triple Qs, we're seeing similar things, but at a much deeper point. If we're looking at this peak here in August of 2022, that's all the way down to 333 on the triple Qs. And, there's not so much of a clear area of former resistance turning into support, pivotal point, no clear pivotal point formation on this run up here on the triple Qs. So um, the triple Qs is a little bit unclear. Obviously, we have the moving average, which could possibly hold as support, but again, we don't know. The whole idea of this is to really just follow the trend. Wherever the trend takes us, that is where we are going to trade. And obviously, we are going to manage the risk appropriately so that way we do not take sustainable large losses, right? Now looking at the most important thing that we have here, which is the VIX. Now the VIX on the weekly candle is creeping up, creeping up substantially. And we can see that it is now at 17. That is a 6% increase on the daily change. Let's take a little closer here, right? So we are hugging the 200 moving average, and it rejected this point here, but again, at this point it pulled back. But what are we doing now? We are hugging the 17-18 level, right? We have not pulled back. We actually hugged this level, and the next point, if we were to get a panic sell, which would be a perfect buying opportunity, which in my opinion we have not seen just yet. We have not seen panic induced in the market. But if we do get a panic, we're looking at the VIX to reach up all the way to 20. Lastly, what we have here is a fear and greed index. And if you remember a while ago when the market was rallying, we were at extreme greed. And what does Warren Buffett always say? Be fearful when everyone's greedy and be greedy when everyone's fearful. Right now, we are stuck right dab in the middle of neutral, and we have not seen any fear just yet. And as we know, September and August or August and September are generally the weakest months cyclically for the year. And this sell-off may just continue on into September. And if it does, we will more than likely see extreme fear. And once that fear dissipates and everyone's wiped out of their accounts because they did not hedge and they just got a little too greedy, that is when we're going to be buying a lot more. I've been buying slowly as we go down, and generally I buy ETFs such as Vanguard Index because I like to stay diversified. And the whole idea is that you get rich with small amounts of money by taking large risks, but you stay wealthy by taking very little risk with larger amounts of money. So that's why I buy Vanguard Index to hold it long term. So once we definitely get into that extreme fear zone on the fear and greed index, that is when we are going to be buying a lot and buying heavy for a possible bounce and continuation higher. So that is what we are looking for. And again, if you haven't already, please go ahead and subscribe to the channel. Leave a like down below, and we will see you on the next one.